Let me ask you a question. If you invested $10,000 today, would you rather look smart on YouTube or actually make money over the next decade? Because those are not the same thing. Most folks out there get sucked into the hype machine. They're chasing the latest hot stocks that everyone's buzzing about, piling into meme ETFs that promise the moon, or blindly throwing money at whatever crushed it last year. And what happens? The market takes a dip, panic sets in, they sell everything at rock bottom, and then they point fingers at the system, or bad luck. Sound familiar? If you've been there, you might end up there. In this video, I'm breaking it all down. I'm showing you exactly how I'd invest that $10,000 across 5 solid ETFs, assuming you've got at least a 10-year time horizon. We're talking real diversification that spreads your risk, smart risk management to protect your downside, and the kind of long-term compounding that turns modest investments into serious money over time. No hype about this will 10 times your portfolio overnight. No fantasy returns that only exist in dreams. Just practical, battle-tested strategies that work in the real world. If you're ready to ditch the drama and build something sustainable, stick around. Let's dive in. First things first. Before I even mention a single ETF ticker, we need to lay down some ground rules. These aren't optional suggestions. They're the foundation of this entire approach. Ignore them, and even the best ETFs won't save your portfolio from your own worst impulses. Rule number 1. When I say 10 years, I mean 10 years minimum. If you're thinking about touching this money in 2 years for a down payment on a house, 3 years for a wedding, or even 5 years for that dream vacation, hit pause on this video right now. This strategy isn't built for short-term needs. Why? Because markets aren't predictable playgrounds. They crash hard sometimes. Recessions roll in like clockwork every few years. Bear markets can wipe out 20%, 30%, even 50% of your value temporarily. And anyone on YouTube or TikTok telling you otherwise? They're either clueless or straight up lying to sell you something. This portfolio is designed for the long haul, where time heals those wounds and lets growth take over. Rule number 2. We're sticking to ETFs, not individual stocks. Look, I get the appeal of picking winners. Nailing that next Apple or Tesla feels amazing. But the cold, hard truth? Most people, including a ton of professional fund managers, are terrible at it. Studies from places like S&P Global show that over 85% of active stock pickers underperform the market over a decade. ETFs flip the script. They give you instant diversification across hundreds or thousands of companies, slashing the risk of one bad apple tanking your whole basket. Plus, they cut down on those emotional roller coaster decisions that lead to buying high and selling low. It's set it and forget it investing at its finest. Rule number 3. Boring is your best friend. If this portfolio sounds a little too vanilla for your taste, if it doesn't get your heart racing like a crypto pump, that's a good sign. Flashy investments grab headlines, but boring ones win marathons. They compound quietly in the background. Avoid those catastrophic blow-ups that wipe out years of gains and consistently outperform the emotional investors who jump from trend to trend. Warren Buffett didn't build his empire by chasing excitement. He did it by being relentlessly dull, and that's the mindset we're adopting here. All right, with those rules locked in, let's get to the good stuff. The portfolio breakdown. Here's how I'd split that $10,000 across these 5 ETFs. I'll explain each one in detail, what it holds, why it fits, the allocation rationale, and yeah, the risks, because I'm not here to sugarcoat anything. Starting with the backbone of the whole thing. ETF number 1, VOO, getting 35% of your money, that's $3,500. VOO is the Vanguard S&P 500 ETF, and if you could only pick one ETF to hold for the next 10 years, this would be the no-brainer choice for most Americans. It tracks the S&P 500 index, which means you're owning a slice of the 500 largest, most dominant companies in the U.S. economy. We're talking heavyweights like Apple, Microsoft, Amazon, Nvidia, Google, Meta, and Berkshire Hathaway. It's not some exotic high-flying bet, it's the core of American capitalism. Why VOO2? Simple. The S&P 500 isn't just a random list. It's a dynamic powerhouse that represents the strongest businesses driving innovation and growth. It automatically weeds out the losers. Companies that falter get dropped, and adds rising stars. Over the last century, it's survived everything. World wars, the Great Depression, stagflation in the 70s, the dot-com bust, the 2008 financial crisis, and even the COVID crash. Historically, it's delivered around 9 to 10% average annual returns over long periods. Not every year. Some years it's up 20%, others down 20%. And past performance isn't a guarantee. But over decades, it compounds like clockwork. Now, why 35%? This is the stable core, but we're not putting all our eggs in one basket. Going 100% VOO would be lazy diversification. We want to layer in more growth and protection. On the risk side, be real. It's got heavy tech exposure right now, which can amplify ups and downs. It's US-centric, so if America hits a rough patch, it feels it. And in a major crash, it could drop 30 to 50%. Think 2008 levels. But if you sell during those dips, you're defeating the purpose. This is buy and hold territory. Moving on to ETF number 2, QQQ, our growth engine allocated at 25%. That's $2,500. QQQ is the Invesco NASDAQ 100 ETF, and this is where we inject some controlled aggression into the mix. It zeroes in on the top 100 non-financial companies on the NASDAQ, which skews heavily toward technology, innovation, and high-growth sectors. Top holdings overlap a bit with VOO, Apple, Microsoft, Nvidia, Amazon, Google, Meta. But it amps up the focus on disruptors like Tesla, Broadcom, and Adobe. Why include QQQ? Because long-term wealth isn't built on playing it safe forever. Innovation is the engine of economic progress. Think about the megatrends shaping our world. Artificial intelligence revolutionizing industries. Cloud computing powering everything from Netflix to your bank's app. Semiconductors enabling smarter devices, and automation transforming manufacturing. You might roll your eyes at sky-high tech valuations, but these companies aren't just hype. They run the modern economy. Ignoring them is like betting against progress itself. But why only 25%, not more? Balance, my friend. QQQ is a beast in bull markets, but it's volatile as heck. It crashes harder during downturns, like a 35% drop in 2022 alone, and it gets hammered when interest rates rise, making growth stocks less attractive. We're using it as a turbo boost for returns, not a casino bet. 25% gives you that upside potential without turning your portfolio into a powder keg. Next up, ETF number 3, VTI, for total market coverage at 15%, $1,500. I know what you're thinking. Hold up, why add VTI if VOO already covers the big boys? Fair question. VTI is the Vanguard Total Stock Market ETF, and it casts a wider net. While VOO sticks to the top 500 large-cap giants, VTI includes everything: large caps, mid caps, small caps. Over 3,500 stocks in total, representing the entire investable U.S. equity market. Why does this matter? Diversification isn't just about owning more stocks. It's about capturing opportunities across the board. Historically, Small and mid-cap companies have outperformed large caps over long stretches, especially coming out of recessions when smaller firms rebound faster. They bring innovation from up-and-comers that might become tomorrow's Amazons. By adding VTI, you're avoiding over-concentration in those mega-cap tech titans that dominate VOO and QQQ, and you're getting a more complete picture of the U.S. economy, from blue-chip stalwarts to nimble growth stories. Why just 15%? Small and mid-caps add spice, but they're riskier. They swing more wildly and can lag during tough economic cycles like high inflation or rising rates. We want exposure to that potential outperformance, not total reliance on it. It's like adding a side dish that complements the main course without overwhelming it. Now, ETF number 4, VXUS, for international exposure, also at 15%, another $1,500. This one's a tough sell for a lot of U.S. investors, and I get it. Why look abroad when America's been crushing it? But hear me out. VXUS is the Vanguard Total International Stock ETF, covering over 8,000 stocks from developed and emerging markets outside the U.S. We're talking Europe. Think Germany, France, the UK, Asia, Japan, China, India, and emerging powerhouses like Brazil and South Africa. Why bother with international stocks? Risk Management 101. Putting everything on one country, even the world's economic leader, is like driving without a spare tire. History shows cycles where U.S. stocks underperform while other regions shine. The 2000s were a lost decade for the S&P 500, but international markets delivered solid gains. Emerging economies are growing faster than the U.S., with rising middle classes and tech booms of their own. Over 10+ years, this smooths out your returns, reduces overall volatility, and protects against U.S.-specific risks like political gridlock or trade wars. The hard truth? International investing can feel messy. Currency fluctuations, geopolitical drama, and yes, periods of underperformance, like the last decade where U.S. tech stole the show. It's not as exciting as domestic plays, but that's the point. It's here for balance, not thrills. Skipping it entirely is home country bias, and that can bite you when least expected. Finally, ETF number 5, SCHD, for stability and income, rounding out at 10%, $1,000. This is our anchor in stormy seas. SCHD is the Schwab U.S. Dividend Equity ETF, focusing on high-quality companies with strong balance sheets, consistent profits, and a track record of growing dividends year after year. It holds about 100 stocks, like Procter & Gamble, Home Depot, Coca-Cola, and Verizon, blue-chip names that prioritize shareholder returns. Why SCHD? Dividends aren't just nice to have, they're a psychological lifeline. In bear markets, when everything's red, those steady payouts remind you why you're invested. They provide cash flow to reinvest or live off, and historically, dividend growers outperform high-yield chasers over time because they signal healthy, sustainable businesses. During crashes, SCHD tends to fall less than growth-heavy ETFs and bounces back quicker, all while paying you to be patient. Why only 10%? This portfolio is geared toward growth for someone with a 10-year horizon. Maybe you're in your 30s or 40s, building for retirement. Too much emphasis on dividends early on can drag down total returns, as these stocks prioritize payouts over aggressive expansion. It's the stabilizer, not the star. All right, let's step back and look at the big picture. This isn't some magical formula that guarantees riches, but it's built on principles that have stood the test of time. Over 10 years, Expect the portfolio to drop during crashes, maybe 20 to 40% in a bad one. It'll underperform those viral meme stocks or crypto plays in raging bull markets. And yeah, it'll feel downright boring most days, with no daily drama to obsess over. But that's the beauty. It compounds steadily through ups and downs, avoids those gut-wrenching permanent losses from bad bets, and crushes the average emotional investor who tinkers too much. Based on historical data, you're looking at 8 to 10% average annual returns long-term. Not guaranteed, of course, and taxes, fees, and inflation play a role. Anyone promising double digits or more is either guessing or selling snake oil. One critical piece most folks overlook: rebalancing. Don't just set it and forget it forever. Once a year, check your allocations and tweak back to the targets. Sell a bit of what's grown too big, like QQQ after a tech boom, and buy more of what's lagged, maybe VXUS during a US slump. This enforces the golden rule of investing: buy low, sell high. And it keeps emotions out of the equation, no second guessing based on headlines. Before we wrap, let's call out the common pitfalls that'll derail you if you're not careful. First, constantly swapping ETFs because you saw a better one on Reddit. Stick to the plan. Second, panic selling during crashes. Remember Rule 1. Time is your ally. Third, chasing last year's winners. That's rear-view mirror investing, and it rarely ends well. Fourth, ignoring taxes. Use tax-advantaged accounts like IRAs or 401s, Ks if possible. And fifth, thinking ETFs means zero risk. They mitigate it, but markets are markets. Look, this portfolio won't make you a millionaire overnight. It's not designed for that. But if you commit to it, stay consistent, ignore the noise, let compounding work its magic, it can build real, lasting wealth. Protect you from your own dumb impulses, and set you up for financial freedom down the road. If you're after excitement, hit up Vegas or day trade crypto. But if you want results that last, this is how real money gets made in America. Drop a like if this helped, subscribe for more no BS investing breakdowns, and let me know in the comments, what's your biggest investing fear? Thanks for watching. See you in the next one.